What a move. Let's not rush this. 20 seconds away from the opening bell. When was the last time you saw a market like this? Intraday. On the S&P 500, futures up by 3.7%. On the Nasdaq 100, post CPI from an hour ago. On the Nasdaq right now, up by 4.9%. It's your opening bell. Switch on the board and take a look at the bond market. The move's just as large. Yields down by 18 basis points on a 10-year, 391.56. On a 2-year, down 20 to 437. Last Friday, after the payrolls report, we had yields very close to 480 on a 2-year. Now all the way back down to 437 and down 21 basis points on a session. Once I've told you that, you can guess where the FX market is trading. The dollar is trading a whole lot weaker. Euro dollar 101.47. That currency pair up by 1.3%. And crude not doing a whole lot. 85.60 on WTI. We're negative by 0.2%. This equity market absolutely ripping. 30 seconds into the session on the S&P 500 up by 3.6%. On the Nasdaq up 5%. A big boost to big tech post CPI. Here's Katie Lyons.
Yeah, John, big tech loves this cooler inflation, probably because it is sending yields dramatically lower on the intraday basis. The 10-year yield is down something like 18 basis points today, and those lower borrowing costs do help hire multiple companies. The likes of Apple, Amazon, Tesla, Nvidia, all getting massive lifts at the opening bell here in New York. Apple up 5%, Amazon and Nvidia up 8 and 7% respectively, and Tesla is getting a lift to the tune of about 7% as well. The thing about it, John, though, is this is just one single day. And yes, we may have yields dramatically lower on the day, but still we're up 240 basis points on a year-to-date basis on the 10-year. So longer term borrowing costs are still a lot higher than they were a year ago, which is why we have seen the valuations for these companies come in so dramatically this year. And what that means is all these heavyweights are less weights than they were in this equity market. In terms of the S&P 500 and the Nasdaq 100, the Nasdaq 100 index share of S&P market cap has been steadily declining. And of course, that isn't just because of a big macro narrative. Their fundamentals have suffered too. Their earnings getting hit by inflationary pressures and the waning demand that has resulted from that. So because of that, the tech sector was the 4th worst performing among major S&P sectors in the 3rd quarter in terms of earnings growth. Actually, earnings were down about 3.3% on a year-on-year basis. And then in communication services, which of course houses Alphabet, aka Google, and Meta, aka Facebook, that was even worse. Profits in that sector down 21% in the 3rd quarter. So it has been brutal road for tech, John. They're just getting some relief after that cooler CPI this morning.
Just massive moves, Katie, and great work as always. Let's go through it together. If you're just tuning in, where have you been in the last hour? CPI 60 minutes ago. The estimates for headline year-over-year inflation were anywhere from 8.1% at SocGen and others to 7.8% at Goldman and others. Year-over-year headline came in at 7.7%. This market, Wall Street, very focused on the potential for deceleration in core month over month. That's exactly what we got. Downside surprise there too. So equities roar, ripping, explode off the back of that. On the S&P right now, we're higher by about 3.5%. If you close the market right now, that would be the biggest one-day gain going all the way back to April 2020. Major moves in equities, big moves in the bond market too, down by 21 basis points on a 2-year, 437. Katie talked about the rest of the year. I'll go through the dates. For the politics, the Georgia runoffs, they're slated for December 6th. For the market, December 2nd on the payrolls report, December 13th for the CPI report, December 14th for the Federal Reserve. That's when you get the projections for 23 and beyond. And we're going to have a much bigger conversation about how far this Fed needs to go. Avoiding recession hinges on how far is far enough for inflation to fall. That's the view from Crossmark's Victoria Fernandez writing this. The problem lies in whether the Fed will be satisfied with 4 to 5% inflation and take that deeply desired pause. If not, and 2% continues to be the goal, then we will continue with more rate hikes and will likely push the economy into recession in 23. Victoria joins us right now. Victoria, I'm going to go back to that quote in just a moment. Let's just start with your reaction to that data an hour ago.
Yeah, I mean, Jonathan, I'm really kind of shocked that we're seeing such a huge response. I mean, especially when you look at the NASDAQ, you and Kaylee were just speaking about that. The fundamentals in those companies really haven't changed. Yes, when they do their discounted cash flows, that's going to be a little bit different. They're long duration stocks, so I can see them rallying a little bit. But 5% when we still have demand that's been pulled forward, you still have restrictions in regards to chips being exported, all of that. I'm really kind of surprised we have seen such a strong rally. We did did expect inflation to come down a little bit. And as you mentioned, month over month is key. That's what the Fed's looking at. And you look month over month, a big component of that was used car prices and apparel. We expected that as well because supply chains were doing better. So I'm glad that we've seen the month over month numbers come down. I'm surprised that we're seeing such a positive move in the markets. I would expect we're going to give some of this back, if not tomorrow, probably beginning of next week.
Well, Victoria, let's break it down then. As always with data, you can learn something from the data and you can learn something from how the market responds to it. What do you take away from how the market's responding to it this morning?
Well, I think we're getting a little bit over our skis, and we've done that before. This is our third, what I consider a bear market rally so far this year. We still have a Fed funds rate that is 250 basis points below inflation. So if you're telling me this is the all clear sign, I'm just not agreeing with you on that. I think we still have a lot of volatility to go. I don't think the Fed is going to stop because of this one number that we see. And you and I have spoken before about the oil and the energy component that we see going for the rest of this year. Remember, there's still European sanctions to go into place in December, along with all the other December items that you mentioned. So yes, we have a decent economy, in my opinion. You've got consumption still there. You know, I love watching the consumer, and the consumer is still strong, but I think there's still a lot of volatility, and I'm not sure that we're ready to ring the all clear bell yet.
Piece by piece then, equities up big time, the S&P 500 really rallying in the bond market, treasuries rallying big time, yields are much lower, down by 22 basis points, the dollar showing a whole lot of weakness. Victoria, as you look cross asset this morning, right now, what do you fade, what do you go with?
So we would be fading any of those names in your equity portfolio where you're a little bit overweight. You want to trim some of those names, take some money off the table. We have been extending duration in the fixed income part of our portfolio, so hopefully you've been doing that as well. If you're an investor, and increasing some of that duration there, because we knew yields were getting close to peak. If you're going to say terminal rate is somewhere around 5%, then peak 10-year rates were going to be somewhere around 4.25, 4.30. And we've hit that. 2 years around 475, 480, we've hit that. So I think you can expect duration to start, or yields to start coming down like they did today. Maybe we go a little bit further, but I would be extending duration in fixed income, trimming on the equity side.
So I think a lot more people getting a lot more comfortable with the idea we've seen the bulk of the rate hiking cycle. I get all of that. So let's talk about the consequences. 400 basis points worth of tightening, there and thereabouts in 8 months. The consequences of that, Victoria, are we starting to see it now? And have you seen enough reaction from the C-suite that makes you say, okay, they're taking it seriously, they're resizing, readjusting, and I'm ready to buy? I'm thinking of Meta cutting 13% of the staff. I'm thinking of Snap cutting 20% of the workforce. Are you seeing enough of that to say, I think we're making the adjustment in C-suite and in corporate America?
So I think we're going to be looking, when we look at earnings for fourth quarter, we're going to be looking for a little bit more of that. Yes, we've seen valuations come down, especially for some of the defensive names relative to some of the cyclical names. So I think you can start nibbling, Jonathan, on some of these when we have pullbacks in the market. I wouldn't do it today, but when you have some pullback to go in and add to some of those names, I wouldn't go full on in tech. I wouldn't go full on in any sector at this point in time. You know, we've been very defensive, and we were adding value for the majority of the year. We're now starting to say, okay, we've seen that cash yield come down on defensives closer to the risk-free rate. So earnings expectations on cyclicals are starting now, because of things we've heard from the C-suite, are starting to stabilize. So maybe that's where you start to add a little bit in your portfolio.
Is housing part of that story, Victoria, or is it still too early?
So, you know, you talk about things having to be broken, and I think the housing market has been broken, and it's probably at the bottom. We saw mortgage applications actually go higher last week, which is a little bit surprising because the 30-year mortgage rate actually ticked a little bit higher as well. But I think maybe that could be an opportunity that you can look at. We actually added a little bit of Home Depot and a little bit of Lowe's to our portfolio over the last week and a half or so, because we do think you'll see some benefits there going forward.
I just want to ask you about the soft landing debate, because that's going to be the debate going into the weekend. Is there anything in this, Victoria, that gives you comfort, changes your mind about the trajectory for this economy?
I wouldn't say it changes my mind, Jonathan, but I would say, you know, a month ago I would have told you a soft landing was a unicorn of an idea. I don't think it's as much of a unicorn now. I still think the Fed is going to continue to push. They say they're going to look for the lag effect going through the economy, but I think they're going to continue to push because they're not going to be satisfied with a 7.7% headline CPI or a 6.3% core. They're going to keep pushing, and I think that's going to lead us into a shallow and short recession next year.
Victoria, I asked this question of Jim Bianco and Krishna Mamani maybe 20 minutes ago. Let me ask it of you. This feels like more than just repricing the December meeting, taking it down from 75 to 50, when you see moves of more than 3% in the equity market and moves of more than 20 basis points lower in the bond market. Victoria, what do you think we're pricing in here?
You've got to be cautious here, Jonathan. I just don't think Powell is ready to make a move. And you can define pivot however you want to define it, as a pause, as not, hiking as quickly. But I think he's going to continue down the path that he has laid. I think we're still seeing at least 50 basis points in December and a couple of 25 basis points in the beginning of next year. I don't think we're getting a pause here yet. So I think people need to be cautious on these knee-jerk reactions in the market and acting on those.
Seen some big moves. Victoria, what a morning to catch up with you. Thank you. Victoria Fernandez there at Crossmark, up by more than 3% on the S&P, by more than 4% on the Nasdaq. Some of the biggest moves we've seen going back to April 2020 in the bond market. Major moves there as well. Down 20 basis points right the way through the curve from 2s out to 10s. On a 10-year down 21 basis points to 387, on a 2-year to 434. Let's break this one down just a little bit more and get some movers off the back of this. Abby, wild moves this morning.
It is incredible, John. And to your point that this may be more than investors, traders pricing in December being a little bit softer in terms of hikes. If we take a look at the average volume on the open, more than 110% above the 20-day moving average. Right now, 40% above. That's another way of saying these dip buyers are serious. They want in, and you can see it with big tech. Apple up 4.5%, Microsoft up 4.8%, Amazon, Nvidia both up more than 6%, the best day since July and May for many of those stocks. So as yields absolutely plunge, you have investors buying the tech weakness, buying that dip. But it extends to this area of weakness that we've had more recently, the crypto bounce. We are seeing Coinbase Global up 8.6%. Big gains right across the board. We even have Block there up 11.4%. So the question around contagion, whether or not the crypto could have some kind of influence for stocks to the downside. Well, it's interesting because if you take a look at Bitcoin here in white and the S&P 500 in blue, a very close correlation. Yesterday, it looked as though maybe that plunge in Bitcoin was going to bring the S&P 500 down. But right now, John, it actually seems to be the reverse. So stay tuned here in terms of this big risk-on move that we're seeing today.
Abby, thank you. We heard from Patrick Harker of the Philadelphia Fed. We're hearing from the Fed's Laurie Logan, of course, of the Dallas Fed, who said this just moments ago. CPI data a welcome relief, but a long way to go. The message from the Fed, the process of cooling off the economy, quote, is just getting started. This was what Victoria Fernandez was talking about just moments ago. Is the Fed going to make a pivot anytime soon? Based on that, I don't think so. Coming up on this program, crypto exchange FTX heading towards bankruptcy, putting the industry in the spotlight.
We need to have strong global standards to make sure that there are no gaps in the international regulatory framework where you can see risks like this spread.
That conversation up next.
We need to have strong global standards to make sure that there are no gaps in the international regulatory framework where you can see risks like this spread and you can have the risk of contagion or even systemic risk spreading to the broader financial system. I don't think we're at that point.
Crypto exchange FTX drawing attention from regulators after a bankruptcy warning. Bloomberg reporting the firm is facing a shortfall of up to $8 billion, needing half of that to remain solvent. The situation prompting rival Binance to scrap its takeover bid. The company writing in a statement, quote, "The issues are beyond our control or ability to help." Team coverage starts right now with Bloomberg's Sonali Basak and Katie Lights for more. Sonali, what a couple of days.
What a couple of days. And now you have Sam Bankman-Fried, the CEO of FTX, online tweeting an apology and saying that he's still in talks with investors to raise, and I say the word liquidity. He does not say capital. He's in talks to raise liquidity. He is trying to make customers whole, and he does say that FTX US, which is the US-based exchange that, you know, operates with people in this country, was not financially impacted by what had happened. And he says that with 100% liquidity there, every user could fully withdraw should they want to. So a lot of people looking to get their money back when it comes to FTX. Sequoia, as you're going to talk about more, is just one of the investors that are facing major losses. SoftBank, other billionaires that have put in money into $2 billion worth of capital raised just last year alone. But to your point, people who put $2 billion in, somehow now there's an $8 billion hole. And how people make that hole full and pay investors back at the end of the day is very unclear and will be very costly as well. His fortune in just a day, $15 billion at least, wiped out entirely. We've reported now multiple times that the SEC, the DOJ, and the CFTC are all looking at how client funds were used. Reuters, John, has reported that about $4 billion of customer funds were potentially used when it came to his other investment firm, Alameda, the trading arm here.
And Kelly, that last piece of the conversation, that thought on using client money that Sonali just mentioned, that's problematic in a major way.
Yeah, and we'll have to see what the legal and regulatory ramifications of that are, John, because this is real people's money that we're talking about here, and they already had suffered greatly in the first crypto implosion of the year back in May when Terra USD collapsed, and we saw the ripple effects of that. I will say crypto's getting a bit of a breather today, in part helped by just risk appetite on the rise after CPI, with FTX's native token, FTT, up about 120% on the day, but it has been a bloodbath on the week for people invested in many of these tokens on the week. FTX's token is down 84%, Bitcoin and Ether down 14 and 16% respectively. And I just mentioned Terra USD, John, which of course was an algorithmic stablecoin. Another asset-backed stablecoin, Tether, is breaking its $1 peg, and that is a sign of potentially further systemic risk as well.
Looking forward to your coverage a little bit later. Special programming coming up with Sonali Basak and Katie Lights. I believe Matt Miller interrupting that show too a little bit later. Looking forward to it. 1 p.m. Eastern Time. Peter Cheer joins us now of Academy Securities. P, I want to start here. For the people who aren't in this asset class, that don't hold any of this stuff, can you explain to them what this might mean for them, the potential for contagion through traditional asset classes?
Yeah, and I think there's two elements of that. One is what it's going to do to markets. So I think there are companies that are directly tied to crypto. Some, that's their business, whether they're miners, some that's where they develop. That's going to be an important loss, and I think that's going to continue, right? People are not going to rush back into this. I'd be fading this kind of bounce in crypto. The other part is, what does this do for the economy slightly longer term? And I've been arguing for a while that this time when crypto got to $3 trillion, it was a big part of our economy. As it's shrinking, it's now below $1 trillion. You're going to see less spending on semiconductor chips, right? They were huge buyers for these mining rigs, for all the software that they needed. You're going to see less ad spending, right? We might finally be able to get through a sporting event without Matt Damon telling us to, march off to do something exciting. And finally, I think we're going to see less energy use as mining drops. So there's going to be a lot of real-world repercussions from this. And that's going to take a little bit longer to play into the economy.
Pete, is that a tradable story?
Yeah, I think it is tradable. I think for myself, it is actually going to add to the deflationary pressure. I think you are going to see, again, with less semiconductor spending, less energy usage, you are going to see some of this deflation that I think we're already starting to see creep back into the picture if you ignore kind of the erroneous housing data we tend to use. So that is actually going to be good for rates, and that will allow a lot of stocks to do well. I think it's going to remain weak for housing. I think you're going to see some pressure on autos. Anything where these people involved in crypto were spending their money, it's just going to create pressure. So I think, to me, it actually really increases how deep the recession is going to be and the timing of that. So I think we're going to get a worse recession. The Fed's already gone way too far. And this crash in crypto is going to contribute to that recessionary pressure.
You've been talking about that for a while, Pete. Let's talk about this market move right now. Then I've got to move on. Yields down 24 basis points at the front end. Equities up by close to 4% on the S&P. Pete, it sounds to me at least that you'd push back against this move.
No, I love this current move. I think we kind of rally for a little while. I think we're going to see yields come much lower as people realize the Fed's going to have to back off a little bit. And we have to make this transition, right? We're going from, recession to some of this thing's going to look like a soft landing. People are going to start talking about soft landing. We're coming into Thanksgiving. It's always seasonally well. So we're getting all this nice noise. And then I think it's going to be as the data really starts hitting that, this isn't soft landing. This is going to be hard landing. We have crushed parts of our economy. We've just taken out another leg of the economy as crypto's gone down. And that's going to be the reality. So I think we can enjoy this for a week, 2 weeks, maybe get back to 4,200 on the S&P. And then I think the reality sinks in.
Sounds like a bear market rally. Peter, thank you, as always. Peter Cheer there, breaking it down on crypto and this market move. Up 5% on the NASDAQ, on the S&P, up by 3.6% with the sector price action. Here's Abby.
John, well, these moves are simply stunning, and one way to put it, green on the screen. All 11 S&P 500 sectors right now up more than 1%. Energy, interestingly, is the worst sector, up 1.4%. Not surprisingly, mega cap tech on top. Consumer discretionary up 5.4%. Think of Amazon. Tech up 5.3%. Think Apple and some of the chip companies. Real estate, this is interesting, also up 5%. That, of course, is a sector, those stocks, high dividends. So when yields plunge like they are today, the dividends on a real estate sector or, say, the utilities look much more attractive. But the bulls are clearly buying today. And relative to some of the subsectors that are also really outperforming, technology and equipment up nearly 5%. The stocks, chips up 5.6%. And then the FANG index and China tech, it is absolutely soaring, up 6.8% on those yields down, John.
Abby, thank you. Yields down and equities absolutely flying. Up next, your trading diary. The trading diary into the weekend. We're almost there. One more trading day after this one. From New York City, this is Bloomberg.
At that all day yesterday.
A downside surprise on inflation, sparking a major rally. Inflation comes in softer, weaker, negative, even on core. Look at this move on the S&P, up 3.9%. The biggest one-day move going back to April 2020 on the NASDAQ 100, up by more than 5 percentage points, and yields absolutely plunging. Twos right the way out to tens. On a two-year yield, down by more than 20 basis points, with lower by almost 25. That's the price action. Here's the trading diary. President Biden speaks again at 3 Eastern. Look out for that. More Fed speak. Mess the Daily George, all on deck today. today. Then we get UMich sentiment tomorrow. Looking ahead to next week, the G20 kicking off, plus more Fed speak. You'll hear from the New York Fed President, Mr. Williams, Monday, followed by Harker and Barr on Tuesday. Bit of PPI data in the mix as well. Tons coming up. From New York City, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Thursday, November 10th. Here are the top market stories that we're following for you at this hour. Finally, good inflation news. CPI slowing to 7.7%. Core rises only 0.3%. Shelter prices, though, still high. We examine if this really is a good number. But meanwhile, the market parties on inflation. Stocks fly, yields sink. Investors downgrading the chance of a 75 basis point hike from the Fed. And FTX's $8 billion hole. FTX hurdles to bankruptcy if investors can't plug a huge cash shortfall. We're going to speak to CFTC Commissioner Caroline Pham. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Obviously, the CPI was a welcome relief for the markets, but is it worth 4% on the S&P by 10 a.m., the best opening in 2 years?
It's amazing. The Nasdaq's up by nearly 6% right now. We're at 5.7% on the upside, and volume is very, very strong. Now, clearly, there's going to be some shorts unwinding here, but nevertheless, this is a very big reaction. But as you said in your headlines, Alex, you got to have your head on a swivel today. You got a CPI number that is seeing markets absolutely surging, equity markets surging, massive move in the bond market, and then you've got this crypto question as well, which we don't know the answer to. There are echoes of 2008 here. How far do those echoes go, I guess, is the question.
Yeah, and then what the contagion obviously also is. There's going to be some in certain areas, but is it broadly contained? I mean, today, obviously, it looks like they're trading on two different kind of things. Yesterday, it felt like tech was getting hit a little harder as crypto continued to roll over. Now, maybe it's a bit of a different story. What I also find interesting, Guy, is even if we can debate whether or not this is a good or bad or medium inflation number, right? But if this means we've seen a peak in the dollar and a peak in yields, that does mean something then to risk assets.
Oh, it does, and it means a lot, certainly here in Europe right now. We've been seeing our currencies pummeled. The dollar's been in charge of the narrative. Obviously, in emerging markets as well, there's been some huge fears around the ongoing strength of the dollar. There is a huge sigh of relief, not just in the United States, but around the world today, that maybe, just maybe, we've got a good inflation print, a better than anticipated inflation print out of the United States. We've got a long way to go, though, to that December Fed meeting, and a lot of data is going to go under the bridge between now and then. This may not be a trend. This may not be something that gets repeated. But our question of the day, Alex, is a fairly straightforward one. 7.7%. That's the inflation number today. Is that good news? How good is the news? Because the market reaction is absolutely epic. We welcome to discuss this and the crypto story a little bit later on, Anastasia Amoroso, Chief Investment Strategist at iCapital, 148 billion in assets under management. Anastasia, let's talk about how good this number is. The market reaction is massive. Is it commensurate with how good the data is?
I think it is. Look, this is an extremely welcome piece of news that we've been waiting for, for months. We have not had a positive inflation surprise. And finally, there's a lot to like in this inflation report. You're starting to see food prices, for example, not rise that much. You're starting to see durable goods that are actually starting to decline a little bit. You're starting to see used car prices that are falling. So you add all of that together, and the monthly print is 0.4. That is significant because in order for us to be on course to 2% year-over-year inflation, we could not have had 0.6, 0.7% monthly prints. We really need to bring them down to 0.1, 0.2%, or maybe even deflationary. And the fact that we have stepped down the monthly pace of increases, this is really the first step, and that's really, really welcome news. Now, we have not sorted everything out. For example, shelter inflation still accounted for half of the rise in CPI, and it rose something like 8% year over year. So that's still a big problem. But the fact that the monthly pace have started to come down, I think does give these markets something to celebrate, and we should absolutely process this as good news.
Okay, so is the good news that inflation has definitely peaked, or is the good news that we're going to continue to see this kind of decline in CPI? Like, which narrative are we buying with the equity market right now?
Well, I think it's been a fool's errand trying to call for peak inflation, and we've been disappointed time and time again. But I think it is a first step in hopefully a series of steps to try to begin to bring down inflation. So that definitely gives the Fed a little bit of wiggle room. And look, they alluded to the fact that they should step down the pace of increases in the coming meetings, if not this next one. So this solidifies that view. And look, I know that, they're still going to continue to hike rates, and the next destination is likely to be 5%, but that's already priced in. And so with the positive inflation print, the Fed is not likely to be more hawkish, and we've sort of priced in this next phase of hawkishness. And I think that's why the markets are really celebrating this and taking it with such positive reaction.
Anastasia, if we stop worrying about inflation, are we going to start worrying about a recession?
Yes, we will start worrying about a recession, and that's why I guess I should be, specific. We should celebrate this today. Maybe we celebrate this, inflation print in the market upside into, the end of the year. But the reality that's likely to come in the first quarter, second quarter of next year is that interest rates are now approaching 5%. Everything from housing to car sales to new goods orders, in the manufacturing space, everything is slowing. And I do think that recession is still in the cards for 2023. Have we fully priced it in yet? No, I don't think we have. So it is good
good news now. My expectation is that this market can continue to be lifted higher into year end. But as an investor, you want to be nimble and think about at what point you want to sell this market.
Yes.
To me, if you rally towards 4,000, 4,100, you start to want to trim certain things. So that would be the playbook right now.
And we've seen that, right? I mean, we've seen like it's not a buy the rip, it's sell the rip kind of situation. So what should your and then you pair this with the end of the year, and we're going to have a lot of book squaring, right? So that's going to also complicate I think the picture. If you're sitting in a lot of cash right now, which many investors have raised, what do you do with that right now?
Yeah, cash is great. And to be honest with you, there's nothing to do with cash right now in the equity space. I'll put some caveats around that, unless you want to go into fixed income and you want to earn yield in something like high yield and private credit. But the reason I say nothing to do with cash in the equity markets right now is because you want to be patient. You want to be buying at the bottom of the trading range, which is not 38 or 3,900, it's 36 or 3,500. So you want to have a little bit of patience, and yes, you should buy things, but I would rather buy them as we trade down to that level. And as you get towards 4,000, 4,100, you start to bump into the 200-day moving average. And as you saw, we've consistently run into resistance there. So I think you want to sell certain things. And if you think about who are the broken leaders in this particular cycle, some of it is big tech, some of it is unprofitable tech. So as things rally towards that 4,100, those would be the types of names, the high growth things that have kind of broken down. Those would be the ones that I would sell on any rallies.
In terms of entry points and thinking about the long term, how precise do you think you need to be, Anastasia, at the moment about your entry point?
Yeah, you definitely have some wiggle room if you're thinking about it in terms of long-term allocations. And I say this because if you've allocated to the S&P 500 when the multiple is at 20 times plus, your forward-looking 1-year and 5-year annualized returns historically were negative or slightly negative or flat. If you allocated when the P's were 16 times, 14 times, 13 times, your forward-looking returns would have been double-digit positive. So I don't think as a long-term investor you need to be all that precise. But at the same time, if we have this trading range and you want to assess what the fair value is and what the cheap entry point is, the cheap entry point is not when we have a 16 or 17 times multiple. The cheap entry point is when we have 15 and a half. The dirt cheap level would be 13 or 14 times. So that's why maybe we're never going to get to that 13 or 14 times multiple, but we have seen ourselves get to 15 and a half, and that's the entry level that I would ultimately target.
What do you do with small caps on something like this? So many were saying that a recession was already priced into small caps, and then you get a boost from lower inflation. I mean, all things equal, if this tones down the recession talk also, this could be gangbusters for small caps. But I'm looking at the RTY, and that's, PE, positive PE 12 times? I mean, what do you do with them?
It's inexpensive, so I think it's one of the sectors that would do well if we manage to avoid a recession. You have a lot of financials exposure, which is again helpful in a soft landing scenario. But I guess if we are thinking about a recessionary scenario, that's not the space that I would probably want to go to, even though they're cheap, because these are companies that are going to be somewhat more vulnerable to an economic slowdown. So that probably would not be my first choice of things to buy, but things that I'd want to buy that have a chance of competing with cash. If cash pays you 4% and eventually 5%, I want to get something in the portfolio that has a chance of beating that. So it's dividend yielding stocks, it's energy, it's healthcare, and that's why I barbell that with some of the things in the credit space, like high yield, like private credit, that gives you a yield of 10 or 11%.
I was waiting for the energy call. I was like, it's coming. The high dividend's coming. It's coming. All right, yes. Anastasia, you're going to stick with us. Anastasia Amoroso, Chief Investment Strategist at iCapital. We're going to talk next about crypto. Is there a systemic risk here through FTX? We're going to look at where the cracks could be. This is Bloomberg.
Wall Street prepares for the latest read on inflation.
This is a worldwide crisis.
We haven't had inflation like this for 40 years.
The score is inflation one, Fed nothing today.
Will inflation finally begin to slow?
The economy is not responding.
We could get to a terminal rate that's even closer to 6%.
Instant reaction on Bloomberg Surveillance.
People are rethinking some of these inflationary inputs.
I'm on the Brent $100 watch.
Can the bear market rally continue?
Inflation in focus today on Bloomberg.
We have, a few billion on our balance sheet right now. We are profitable. We're in a relatively strong place from a financial perspective.
I want to be doing something net positive, like with the making money part. I want to be a good actor there.
We'd raised a few $1 billion over the course of the last couple of years, and we're a profitable business. With Voyager, I think there's $70 million there that we put in that I'm not sure we're ever seeing that $70 million again. We've not used the majority of the cash that we have on our balance sheet. We want to be flexible. We want to be in a position where we are, looking forward at, what we can be doing, where we can be most helpful, and where we can grow the most. I'm excited about Pathway Forward. I'm really excited about our leadership.
Things are happening pretty fast around here, aren't they? That was, of course, Sam Bankman-Fried of FTX speaking to Bloomberg Television over the last few months. Now, of course, his firm faces bankruptcy if it can't secure funds to cover a shortfall, which could be as high as $8 billion. Joining us now for more to discuss the implications of what is happening with SBF, what's happening with FTX, and what's happening in the wider crypto space is Bloomberg's Sonali Basak. Sonali, is this crypto's Lehman moment?
I think that Lehman moment is a really tough word to use. Lehman moment meant a bailout, a U.S. bailout guy. And we're not talking about that kind of damage in the system yet, but people will lose a lot of money in this debacle. That is for sure. Other parallels have been drawn. For example, we have heard MF Global. Is it more like LTCM, where it required an industry-wide bailout at the end of the day as well? That was kind of pushed by a regulator. So there are other parallels to be drawn, but Lehman moment is tough to use. However, the contagion of what happened to FTX has not yet really been felt by the entire system. I keep on referring to Jim Bianco here for a second, just because last night, the minute he had really kind of absorbed all this, what he had mentioned was dozens of firms might fail on the back of this. And you really have to see if other firms are going to be impacted because they can't get their money back, or other reasons that are tied to tokens or other assets that have fallen on the wake of the decline of FTX.
So let's just read through that line. So you have VC investors that put money into the actual platform. Then you have Alameda and the hedge fund and the money there. And then you have the actual people who trade on FTX. Where is the biggest logjam, and where can the money come out?
FTX's balance sheet alone is a big question mark, because we've reported Jillian Tan had gotten a hold of what was said in the conversation yesterday with investors, that $8 billion hole in its balance sheet. Where is the money? Where's $8 billion? How did that get lost? There was a Reuters story this morning that had also said that Bankman-Fried had transferred at least $4 billion in FTX funds secured by assets including FTT shares and shares in trading platform Robinhood that were seeking to prop up Alameda, his trading firm. He said he's winding down that trading firm as well. So to your point here, there are a lot of potential assets that we have to keep a look at when we are thinking about the potential ramifications of what happened with FTX. More than a Lehman moment, how much does this dent confidence in a larger system? Sequoia had lost a lot of money as well by writing down hundreds of millions of dollars worth of their investment here. Future investment, not just in crypto, but in venture capital, dented on the wake of what had happened here at FTX.
What's meant to be stable within the crypto industry is some of these stable coins. Let's talk a little bit about Tether and echoes from 2008. 2008, the breaking of the buck when it came to the money market funds was a huge deal. Today we've got Tether trading below, or earlier trading below, the buck. How big a deal is that? Because that's meant to be how you're meant to be able to move things around the system easily. It's meant to be the source of stability within the system. Sonali, that is untethered today, as the graphic says.
And that does start to get scary. Once you start to talk about stable coins and the relationship they have to the more traditional financial system, we do see other stable coins trading more evenly and not having decoupled from its peg to the dollar. But to your point here, Guy, we have seen Tether start to decouple today in the last 24 hours, and investors are watching that very, very closely because of that link to the traditional financial system. Now it's backed by a number of assets here, but to your point, when does the rubber hit the road when we're talking about crypto and where it really meets the traditional financial system? It's right there. It's in stable coins, and that's why every central government around the world is really keeping such a close eye on stable coins as well as digital assets at large, and it's something worth keeping an eye on.
All right, Sonali, thanks a lot. Super appreciate it. Bloomberg, Sonali Basak joining us there. Still with us here on set, and Anastasia Amoroso, Chief Investment Strategist at iCapital. I mean, that's really to you, right? JP Morgan said that this is making a new phase of crypto deleveraging that could be induced by this collapse, and you could see cataclysmic selling. Is there a line to be made through this to another part of the market that is more systemic?
I don't think it is systemic to the broader market as 2008 was, but I think there are parallels to 2008, and I'll come back to that in just a minute. The reason why I don't think it's systemic to the broader market or the broader economy is we looked at some of the exposures, and for example, households, U.S. consumers have about a 10% exposure to crypto, or 10% of individuals have exposure to crypto. So it's not like 66% of people who own a home and have a mortgage in the home. So that's different from 2008. You know, the other thing, the big deal, the big difference right now is the banking exposure, and banks have started to maybe make allocations to crypto, but it is $9 billion according to the recent estimates, so it's still a drop in the bucket. And so where the rubber meets the road here is it's the VC community that has financed most of the crypto company expansion, and something like $180 billion of venture capital money was raised to invest in these blockchain and crypto companies. So that's where I think the bulk of the losses are likely to occur, but it's not in the banking system, and the banking system either way is much better capitalized. You know, then we looked at the corporate exposures, we looked at the pension fund exposures, and there are some, but they're still in the very low single-digit percentages. So for all those reasons, that's why I don't think it has to be systemic, and I don't think it's going to have this cascade of, you know, selling pressure that cascades through the broader market. Having said that, I think it is absolutely going to dent some sentiment around tech. Because if you think about these venture capital funds, they're not only investing in crypto, they're also investing in other growth companies. And if they have losses in one part of the portfolio, they might not be able or willing to take that additional risk. So I think the whole VC backing of tech is going to slow down. The multiples will come down. And so the risk appetite in tech is going to come down. And by the way, you know, crypto was a big consumer of things like semiconductors. Yep. So all of that is linked, Guy. I don't think it's systemic, but what really worries me here is that I don't think we truly have the transparency of how much leverage there's in the system and how much packaging there is in the system. And that's what really worries me about here, and that's what brings me back to 2008, you know, to the CDO Square type conversations. You know, there's a lot of financial engineering that we're sort of beginning to reveal within crypto, and that is a concern.
How deep do you think it goes?
Sorry, say that one more time.
How deep do you think it could go? If we're comparing it with CDO Squared, then how systemic could this ultimately be? What people are trying to understand is how far does this go? If it stops with the VC community, then it feels containable. If it goes beyond that, then and is linked to other assets, and we were just talking about Tether, and that's meant to be the link to the dollar. If you start to think about how we're compounding at every level the stress, we don't know how far that stress could ultimately go then.
Yeah, and that's what we try to gauge with looking at some of the percentages that individuals and banks and corporates allocate to it. But if you think about it this way, at one point the cryptocurrency market cap was $3 trillion, and it is around $800 billion today. So that's a significant decline, and that's going to be spread around between probably mostly individuals and some corporate exposures. You know, to put that in comparison, the declines in housing equity, for example, were about $3 trillion. The declines in the NASDAQ had back in 2000 were about $4 trillion. So we're sort of on par for those losses, but again, they're not as widely distributed. If you think about that $180 billion in VC funding, once again, that went into these companies, of course, the valuations of them are much larger. I mean, FTX alone, $32.5 billion valuation. In the last round, that's been written down to zero. So there's absolutely exposures, but again, Guy, the fact that the banks have not participated broadly, the fact that institutional investors have participated but not broadly, and the fact that most of the individual consumers, I mean 90% of them didn't have crypto exposure, the fact that they have been insulated. And by the way, most individuals are not exposed to venture capital. Who invested in venture capital is mostly institutions at this stage. So I think that's what insulates us, but that's sort of how how we sum up and quantify some of these exposures.
Amazing. Really great analysis. Thank you so much. Don't worry, no one understands Guy when he talks. Anastasia Amoroso, Chief Investment Strategist in iCapital. This is Bloomberg.
Our intention is to run again. That's been our intention, regardless of what the outcome of this election was.
That was President Biden on his 2024 plans. Joining us now on the latest on the midterms is Bloomberg's Anne-Marie Hardern. Anne-Marie, that was Biden yesterday. Clearly, this inflation data also a nice little victory for him.
Yeah, and I imagine the White House not just breathing a sigh of relief, and they certainly are, with the statement coming out from the president saying he is seeing progress, and he also pointing to the fact that gasoline prices are down. But you have to think they might have wished this came out on Monday before the rest of America who didn't vote early went into the polls, because this inflation rate is the lowest it's been since January, and this was the #1 concern of the electorate. So this is one thing that the president is definitely feeling good about, not just as he says he intends to run for 2024, but also before he goes on a massive international trip and meeting with other G20 leaders.
Anne-Marie, Donald Trump seems to be having a bad day.
He's having a bad day today. He had a bad day yesterday. I want to bring you the headline from the Wall Street Journal editorial board today. Trump is the Republican Party's biggest loser. He has now flopped in 2018, 2020, 2021, and 2022, and everyone is starting to just point fingers at him for some of these candidates that were not able to pull it out, Republican candidates. The fact that the Democrats were able to flip the seat in Pennsylvania because of his candidate choice, Mehmet Oz, and there are reports Trump is blaming that one on his wife.
Amazing. Anne-Marie, thank you very much indeed. Bloomberg's Anne-Marie Hordern joining us from the White House. We're back to inflation next. Omer Sharif joining us to talk about this number. This is Bloomberg.
Jobs Day, like Bloomberg.
All right, we're about an hour into the U.S. trading session with an enormous rally underway. S&P up 4%. I don't think I've ever seen this, not since 2020, right? Abigail's tracking those moves.
That's absolutely right. This is extraordinary, Alex. This move that we're seeing for the NASDAQ 100 up 5.5%. Its best day since the spring of 2020 on that pandemic rally out of the low. That's the kind of buying action. It's also on above average volume, 40 times above the 20-day average. So the dip buyers, they mean business. And of course, it has to do with that cooler than expected CPI print down for a fourth month in a row, really bringing into the idea that it might be peak CPI. As a result, take a look at rates absolutely plunging. That 2-year yield down 28 basis points, the 5-year yield down 30 basis points, the 10-year yield back at 3.8%. This, of course, helps stocks because it makes them look less expensive. In fact, if we go into the Bloomberg terminal and we take a look at the Fed's terminal rate, this is really the key driver. So the point I would make, yes, we're back at 5% off of the 5.25 high, but the trend is in place. So it may be too early to really for stock bulls to be getting back into business like this. We won't know until we see whether or not that cracks 5%. If that trend cracks, that would strongly suggest that the situation, liquidity, is going to ease up and this buying makes sense. If we take a look at sector-wise and some of the big movers, we have investors fully committed, though. The retailing sector up 8%. The idea that consumers are going to be feeling less inflationary pain, they're going to be able to get out there and shop. The consumer durable goods good. That is also sharply higher. Take a look at AMD because we have technology outperforming as well, but the stocks in particular up 10.7%. And we also have Amazon up about 10%. The idea of that big cap tech doing well because yields are down, but also, again, consumers getting back out there to shop. It's going to be interesting to see whether these moves will make sense in the long term or not. But when we put it into the context of the VIX is in this range. It looks very likely to drop back down toward 20. The question, though, Guy, is will the range around 20 break to the downside to go toward the lows of 2021, or is there going to be more pain ahead? Clearly, we're in a bear market rally. We just don't know whether or not the bear market is over, if we have seen a bottom, or again, if this is just sort of some sort of temporary reprieve for the S&P 500 back above 4,000.
Got to think about that recession that could be coming down towards us. Abigail, thank you. Abigail Doolittle on what's happening in the markets. So as we've just been hearing, US inflation cooling last month by more than anticipated. Massive market reaction on the back of it. It's going to give the Fed maybe some room to slow down its rate hikes. Could we go from 75 to 50 in December? Here with all the details, Bloomberg's Mike McKee. Mike, how good was this number?
I feel like this is the old Johnny Carson routine. It was so good that Fed officials are now talking about the possibility of slowing down their rate increases, not really doing a whole lot more than that. But here's the thing. It was unexpectedly good, and it did show some good news pretty much throughout the data. We saw the year-on-year numbers fall. That's not really what the Fed's looking at. They're looking at the month-to-month changes. And there we saw gasoline rise. You knew that if you drive. That was up 4%. But that's not the key number this month. The key numbers are food at home up 0.4%, but it was up 0.7 the prior month. Owner's equivalent rent, housing, still pushing up on services, but up 0.6 instead of 0.8. You're looking at used cars down 2.4%. Took a while to get that into the CPI, but now we've got a trend going. That's really moving down. And apparel, I know it's a good time now to go out and shop, Alex. Women's clothes down 0.7. Apparel down for 2 months in a row now. Overall, goods prices falling as supply chains get better. Services prices still moving up, which is a problem for the Fed. But in general, the reaction we're getting from Fed officials is pretty good. So far, we have had 2 Fed officials speaking today, and both of them saying pretty much the same thing.
In the upcoming months, in light of the cumulative tightening we have achieved, I expect we will slow the pace of our rate hikes as we approach a sufficiently restrictive stance. But I want to be clear, a rate hike of 50 basis points would still be significant.
While I believe it may be appropriate to slow the pace of rate increases so we can better assess how financial and economic conditions are evolving, I also believe a slower pace should not be taken to represent easier policy.
And I was asked the question a little while ago that flowed from what Abby was talking about a few minutes ago, the terminal rate, where do they stop? They're not going to tell us. They're going to keep that open and wait and see if we get more than this 1 month's good news. But it is good news for at least 1 month, guys.
All right, Mike, thanks a lot. Really appreciate it. Hey, we got some breaking news for you concerning FTX. This is according to Dow Jones. Headline looks pretty grim. So apparently, and this is according to a person familiar with the matter, FTX lent billions of dollars worth of customer assets to fund risky bets by Alameda, which is the trading firm run by Sam Bankman-Fried. Apparently, Alameda owns FTX about $10 billion, and FTX extended loans to Alameda using money that customers had deposited on the exchange for trading purposes, and that's a decision that Mr. Bankman-Fried has described as a poor judgment call. Again, that's according to a person familiar with the matter, and that's according to Dow Jones. That's an ugly headline, Guy. Just to take a moment on this, taking client assets and then basically funneling it to your hedge fund in the billions and billions dollar worth of range feels pretty ugly.
We've seen this before. We've seen events like this taking place. They took place in the build-up to 2008. When the tide went out, we started to see some clarity around all of this. Might not be the Lehman moment, but it might be something eerily similar. There were obviously other instances where we've seen this happening. Lehman, MF, Bear Stearns,
Yep.
just keep watching and waiting to see what happens next.
Yep, the regulation. Just how many other companies did this, I think, is the question, or was this an isolated incident also? Okay, let's get back to the other top story, which is what happened with the inflation data. Here's a guy who called it right. Omer Sharif is Inflation Insights founder and president. He was spot on with his forecast, nailing that core CPI monthly number. Omer, what was your broadest takeaway? We're all so excited about the 7.7%. Does it continue to fall rapidly?
I don't know about rapidly because, again, when we talk about the headline, it's always just dependent on where energy prices are going. And you know better than anybody how volatile that has been this year and probably is going to continue to be for some time. But I would look at the core as a pretty broad-based deceleration. So we saw a lot of things fall across the goods categories. It wasn't just used cars. New car prices have slowed down a lot. Furniture prices, apparel prices. So there was a lot sort of under the hood that I think it represents encouraging news in terms of getting inflation to slow down over the coming months.
Omer, but was this just a moment in time where all of that did come together to produce a result that was better than anticipated? Is this something that we can continue to replicate, or was this just a one-off?
Yeah, look, that's a great question because we've had a couple of head fakes this year, right? We had a March and a July print that were both 0.3, followed by 0.6s. So is this going to be like that? I don't think so. I think we have more sort of persistent downward pressure now coming over the next several months. So, we talked about used cars. That's one area, the slowdown in new cars. But I think we also anticipate that shelter costs around the turn of the year into Q1 will also start to finally moderate. We saw medical care down. There's going to be a persistent drag on medical care over the course of the next year. So I think there's a lot more going on here than just a one-off that looks good today but could end up being poor in a month. I think this is the start of a more persistent string of lower readings than we have seen for the most of the last year.
So used car prices, I can kind of see that was a pandemic issue that's maybe getting sorted. Medical costs, I can see rolling over, particularly with the Inflation Reduction Act. But what's going to bring shelter costs down? Because up 0.8%, that's the biggest rise since 1990. What led it, and then what's going to lead it down in the first quarter?
Yeah, so that 0.8 was in September. We actually cooled off rents today to 0.7 and OER fell to 0.6. I think what's going to cool it off is the fact that we're already seeing new lease rents moderate quite sharply. We've seen that really since the spring, earlier in the year, whether you want to look at CoreLogic, Zillow, Apartment List, all of these metrics have been slowing down quite dramatically since earlier this year. The CPI lags all of this stuff by roughly about a year. So we should see, around the turn of the year into the spring of next year, the shelter costs really start to moderate and pick up what is happening already in the rental market where new lease rent growth has slowed quite dramatically. So that will get picked up. It's just we have to wait on it because of the lag. And you heard Chair Powell actually talk about this in the press conference where they're well aware of this lag issue, but it is coming.
Yeah. Omer, the Fed's going to want to see inflation on a sustainable path back down to target. Is this the first step on that journey? How long will it take?
Yeah, so I think that this is the first step on the way. I've been sort of calling for a lower string of readings for a little while as we got into Q4. I think this is a first step to seeing a more persistent slowdown in that core. The other thing I think they really want to see, besides just where the number prints, is they want to see a broad-based deceleration in inflation, right? It can't just be used cars or it can't just be medical care. They want to see everything sort of slowing down more persistently. I think we got to some way there today. The median is still going to be quite high. The Cleveland Fed will publish it pretty soon. If they haven't already, probably still about a 0.5. The 16% trim mean that they pay attention to will probably be around 0.35. So you see some moderation versus what we've seen, but still relatively broad-based increases. So we're going to need months of that, which I suspect we are about to start getting.
Omer, what is the policy lag from the Fed? So did any of this reflect the hikes that we've already seen?
Yeah, look, I think to some extent you could maybe make the case that we've seen some of this, in housing and in the rental market, but the Fed only really just started hiking earlier this year. It's sort of hard to believe given where we are today in terms of where the funds rate is, but I'd be a little surprised if it's really starting to work its way through. I mean, for example, auto financing costs have increased. So we know that prices for leased vehicles are starting to decline. Although I think that mostly reflects the fact that new vehicle prices went up so dramatically. So I'm not sure we've really seen everything pass through into the real economy just yet, which is why I'm glad that they're starting to step down and probably will step down, I think, to 50 bips in December.
Omer, how disinflationary for the U.S. economy is a strong dollar relative, kind of as we have it now?
Yeah, look, I think there's a lot of arguments here about this. I think a lot of folks think that this should really push down on import prices, so everything we're buying from abroad should really start to decrease in price, or at least that growth rate should slow down. I'm personally a little bit less of a believer in that pass-through from the dollar into import prices into what you pay to buy something on the shelf, mostly because import prices tend to be a relatively small component of the actual price. So the price that you're paying for an item is much more sort of tied into the labor costs, the cost of leasing that store, that property, transportation costs, and so on. So I'm not a huge buyer in that. I'm not banking on that really slowing inflation down moving forward. I think it'll help at the margin, but I'm not putting a ton of weight on that.
Omer, kudos on the calls. Thank you very much indeed. Omer Sharif, founder and president of Inflation Insights. Thank you very much indeed. Coming up, more on inflation and how it's being felt by companies. Snap-on CEO Nick Pinchuk is joining us next. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. Control of the U.S. Senate comes down to 3 races where votes are still being counted. Each party needs to win 2 of those states to secure a majority. Georgia, Arizona, and Nevada are still in play. The race in Georgia is headed to a runoff next month. Neither Democratic incumbent Raphael Warnock nor Republican Herschel Walker were able to get 50% of that vote. President Biden says he still has plans to seek re-election and will likely make it official early next year. The president spoke after Democrats avoided the worst-case scenario congressional losses in midterm elections. He said the final decision on running again depends on his health and discussions with his family. And in other news, new Twitter owner Elon Musk has emailed his staff for the first time and warned them of, quote, difficult times ahead. Musk wrote that there's no way to sugarcoat the message about the economic outlook. He also said remote work will no longer be allowed and employees are expected to be in the office for at least 40 hours a week. Global News 24 hours a day on air and on Bloomberg Quick Tape, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Guy.
Thank you very much indeed. Let's carry on the conversation around what is happening with Twitter. We're joined by Bloomberg's Ed Ludlow. Ed, we've just seen a whole lot of people fired from Twitter. A lot of people like working from home. How problematic is this going to be?
Yeah, I mean, Kurt Wagner and I reported a couple of weeks ago, right, that Elon Musk would do this. It's completely the opposite of Twitter's culture. You know, in March of this year, which seems such a long time ago now, Parag Agrawal, when he was CEO, introduced this kind of indefinite remote working policy. You know, Twitter had a number of other policies that were kind of classic Silicon Valley, keep the employee base happy, play. Elon Musk doesn't do that. This is pretty consistent with what he has as policy both at Tesla and SpaceX. You come in, you work hard, and you work with people in person.
Exactly. And I feel like Wall Street's getting back to that in some ways too. Hey, Ed, we also had some breaking news. Amazon up 11%. Dow Jones reporting that the CEO is going to be reviewing its staff. So there's definitely a launching cost-cutting review led by CEO Jassy. Pair that with like what we're learning from some of the earnings that are coming out. Then you also have Rivian still dealing with supply chain issues, and they're still having some working out kinks in the armor. And then you have Amazon reviewing its cost-cutting measures.
Yeah, I mean, in Amazon's case, the Dow Jones report says that they're basically identifying unprofitable businesses, seeing how they can cut costs, and according to Dow Jones, telling staff in those unprofitable businesses to find jobs elsewhere within Amazon, which is an interesting line. Look at the stock. I mean, it's having its best day since February. It was already up 10% on the inflation print because decelerating inflation right in the holiday quarter is pretty good news. Rivian, cost discipline. Consistency is king. Street saying, oh, nice. They reaffirmed guidance. There are no surprises. Stock's up by a lot, the most since May. Everyone's happy.
All right, Ed, really appreciate it. Appreciate the update there. Bloomberg's Ed Ludlow joining us. Well, let's get more on all of these issues. We talked about the inflation number sort of starting to finally roll over. Then you kind of have to wrap in what's happening in the tech industry and job cuts and what all that winds up meaning for final end demand. So let's ask someone who's actually on the ground dealing with all of this stuff day to day. Snap-on chairman and CEO Nick Pinchuk. He joins us now. Snap-on is a tool manufacturing company based in Wisconsin. Nick, tell me about your costs right now. Are they rolling over as much as the overall CPI would have us believe?
Well, I think that the costs are on the way down, but it's mixed, you know. For example, for us, if you're talking about things like wrenches, they're flattening out. They aren't lower than last year, but they haven't gone up in recent months. If you're talking about plate, hot and cold rolled steel for things like toolboxes and lifts, they're going down and they're below last year. Freight costs are a big factor. So from China to Europe, they're down. From China to the United States, they are not. But the big factor that is not, I don't think, captured in a lot of this is the disruptions are still going on. You know, China just closed down Guangzhou. So you see this kind of floating through the economy, and this drives a certain amount of cost because if you can't get things, you got to go out in the spot market. And so that makes a difference. That drives your cost up. But in general, I'd say they're abating and looking good going forward. The good thing, though, is the economy is pretty strong at the grassroots level. So that's in the backdrop of lowering costs and good economy.
Nick, how quickly do you think this inflationary impulse therefore abates? You talk about things are looking good. How quickly do you think things improve from here?
Well, look, I think they've been improving for a while. If you look at the trend, I think I was on in August, and I think they have been improving. That's the kind of thing that I think is going forward. I do believe that you'll see this kind of improvement continue. The real question for a company like Snap-on, a manufacturing company, is how much does the disruption stop? How much does the need to go out on the spot market stop? And that's one of the factors. But one of the things is I think the economy's got a lot of momentum.
Well, okay, to that point, because you going out to the spot market also depends on what the demand picture is like. Has demand changed at all, and what's your visibility?
It's only gone up. You know, one of the things that, if you talk about the economy, it's like Dickens. It's the best of times and the worst of times. If you watch TV and you watch the stock market, you're seeing people worry about the stock prices because of the higher interest rates and the perpetuity rates leaning on the cost of stock prices. And if you watch Bloomberg, I think you feel like you're getting a second coming of Paul Revere. The recession is coming. The recession is coming. But if you walk among the people, of work, like factory workers and mechanics and so on, they are very, very positive. And they see it in the numbers. You know, take car mechanics, for example. They're adding car mechanics every day, and the shop owners are saying they need more. So you hear it in the voices of the people who work that they're very positive. One, they see their businesses being strong, and then they have a residual good feeling from the fact that they were at their post through the COVID, and they conquered it. They feel pretty positive about that. You see it in our numbers. Our numbers were up 10.4%, and the margins were up 90 basis points in a quarter.
Nick, we'll try and be more cheerful going forwards. How big a factor is the dollar in all of this? How much of the stuff that you use comes from outside of the United States, and therefore is a strong dollar a factor in keeping your costs down?
Actually, it's more for exports for us, is that we make in the United States and we export to certain markets. We generally make in the markets where we sell, so we're not as exposed to that. I would think the fact that the stronger dollar has helped people somewhat to abate inflationary costs coming from places like China and so on. But I think China has become a situation where I think manufacturers are kind of leaning away from it because it's a great market. You want to be there to sell. But I lived in Asia for 11 years, and one of the great advantages of China, and hasn't been talked about a lot, is most economic decisions were local. So if you went into Shanghai, you'd do a deal with the mayor, or Shanxi province with the province chief. And whatever happened in Beijing, Jiang Zemin, this actually happened. Jiang Zemin's plane comes back and it's bugged. In an ideological crisis, it doesn't interrupt local economies or local deals. But now, Beijing is controlling everything, and the local people are afraid to sign off on $5,000 worth of deals. And so that's changed things. It's not such a reliable source anymore.
So, Nick, we have 30 seconds left. So scale from 1 to 10, 10 being really hard. How easy is it to find workers right now?
3. It's always, manufacturers always had a difficulty, but Snap-on, we haven't had a problem because we never laid off people. Throughout the pandemic, we didn't lay off anybody. So we kept them. We weren't starting from behind. And I think it is easy to find manufacturers for people who have done that. In terms of manufacturing companies, it's more difficult because the skills and the reputation of manufacturing is difficult.
Nick, I'm glad you're feeling positive. It's great to hear your story. Thank you very much indeed. Nick Pinchuk, Snap-on Chairman and CEO. This is Bloomberg.